Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. And welcome back to another episode of Integrated Insights. My name is Michael Hefner. I'll be your host today. I'm joined again by Andrew McQuilkin from our office. Today's episode, we're also excited to welcome Brandon Herbison, Vice President with Plains Capital Bank. Brandon is a commercial loan officer with more than 12 years experience in the banking industry and business financing. As an active community member, Brandon serves as the board member for Community Lifetime Center and is on the board of directors for the McKinney Chamber of Commerce. Brandon has built a reputation for supporting business owners through complex financial decisions, and with his extensive knowledge of commercial lending and dedication to the local business community, Brandon brings valuable insights regarding the financing options for M&A deals. Well, hey, so today we are going to be talking about banking and trying to give business owners just some expectations that haven't approached an M&A deal before. So just to get started, what are the most common financing options available for small business M&A deals?
Yeah, absolutely. So typically on small business lending or any M&A type of stuff, we go more towards term debt. So you have somebody that's got a service industry and they're, hey, we're looking to retire, sell our business. Say it's for $1 million. Okay, well, you got a new, the buyer coming in that, will come down with a portion of a down payment as well. But typically we'll try to amortize that over, 10 or 25 years, depending on the collateral type really is what dictates that. But allow that the buyer to service that cash flow over a certain amount of time compared to, some other options. You may have some short-term working capital pieces in there, but yeah, so for the most part, you go into the term debt, which I'm sure we'll talk quite a bit through this piece, but is mostly around SBA financing, which is Small Business Administration. So SBA 7(a) loans are the most common types, I would say, for a business owner coming in. Again, that's a term debt loan. So, you can't have an interest only period on the front end of it. But what that, again, allows you to do is pay it down and pay it off over 10 or 25 years. So there's a lot of kind of caveats to it. But what that option allows us and the borrower to do is kind of mitigate, a little bit of the risk within kind of the startup or new business owner piece to M&A deals.
Hey, Brandon, what determines the term on that, right? So you kind of mentioned, hey, the different terms for it, 10, 25, 20 years, whatever it is. What determines that? I mean, I'm sure that there's a lot of things, but can you give us some examples?
Absolutely. Yeah, it's mainly circled around the collateral for the deal. So if you have real estate attached to it, that's when we're able to go out to 25 years on those deals. If there's no collateral, if it's, you get to see some that, may just be, hey, we have some finish outs or we're, going in and buying equipment, receivables, other kind of business assets. That's when you want to shorten the AM a little bit. Most will, go towards more the useful life of the collateral piece. So through the SBA, if 51% of the purchase price in a merger involves the real estate, then that's where we can go on a 25-year amortization.
So who's typically the person that is going after? We know SBA is a big deal, right? And so who's typically, wanting to go after an SBA loan?
Absolutely. So I preface it all with every bank is required to look at it conventionally before they do go through the SBA route. But with SBA, it is a good program, especially for being government run. They do a good job where it mitigates really a big collateral or a big weakness for the bank, whether it's a lack of collateral. You'll see some blue sky type of deals within mergers and acquisitions. So like I said, typically a lack of collateral is a big piece that the SBA mitigates for us. The other piece may be, maybe the cash flow just wasn't there. And this new business owner already has something already set up and they're just acquiring another firm that will and hey, here's our plan to turn around the cash flow, and we're able to mitigate the historical cash flow by using the SBA. So that's that's the main purpose of it. Is the SBA guarantees a portion of the debt for the banks, so that allows us to do what would be a little bit riskier deals. Not be able to get done conventionally, but gives us that extra arm to go out and do an SBA loan.
So with all the options available, right? Because there are limitations, but there's also typically multiple options for everyone that comes to the table. So how does a business owner decide which option is best based on the options available?
Yeah, absolutely. So it's mostly dictated around if it's permanent working capital, long-term working capital, or if it's short-term. So really the two main ones you see are SBA Express loans, which is a short-term working capital solution. Think of that as your standard line of credit. And then you have the 7A, which is more the term debt. So again, I would say we've acquired a business. Maybe it's on the smaller side, but we just need help, with some working capital from an AR standpoint, inventory, and collecting some of that stuff. We just have that working capital need. That's where the SBA Express loan typically comes in. It's a little bit more flexible compared to the SBA 7A, where it's a term loan, and you kind of have everything already figured out from a cost standpoint on the front end of it that you'll see.
So just Brandon, with that, with working capital, I know we deal with working capital. I mean, that's one of our specialties, right, in deals. And so when we talk about working capital, normally in most deals that we have done, if not all, there is some sort of, seller's going to leave some working capital. I mean, some working capital is purchased alongside with the business. And so what, when you're talking about those kind of loans, are those in addition to that, or is that more, hey, there was this working capital, there's nothing that was bought, the accounts receivables, they didn't go with it. And so what, we're here to give you some sort of line of credit to help with working capital. Is that scenario? What scenarios is that, applicable for?
That's exactly it. Yeah. So typically we see them kind of work in tandem. So you get, hey, we'll do a 7A loan just for the acquisition of the real estate, equipment, overall business assets. And yeah, there may be some working capital left over from the seller of it. With that, we'll do calculations to see kind of how much working capital you need. Hey, maybe it's a $5 million revenue business today, but we're looking to take it to $10 million, in the next year. Well, that's going to take some working capital. And so what we typically see on that is that we'll do a 7A loan and also at the same time do an SBA Express loan. So the term loan just starts amortizing day one, going to principal and interest payments from there. And then that SBA Express loan kind of allows a little bit more of the dry powder, if you will, to kind of store up, hey, it took a little while to collect receivables or whatever it may be on this month. And, we need, $50,000 drawn on it just to keep our bills paid and things like that. So it's typically see them quite often. So on the banking side, we will underwrite kind of all of that. So we'll say, okay, yep, what does your working capital analysis look like on the back end of it? Hey, maybe the business has plenty of cash liquidity into it. We're looking to just kind of keep it at the same level. Okay, great. Maybe you don't need that SBA Express, but again, hey, we're looking to grow it. That costs money a little bit on the front end with payroll and again, collecting the receivables and that timeline to get those in. So that's where the SBA Express is a pretty good partnership at the same time with those initial term loans.
Yeah, we always, one of the things that a lot of people don't expect is that post-transaction, the buyer will experience some sort of decline for a period of time before it really kind of comes back. And that, depending on the business, it can last a couple months, it can last, a year, whatever that lull period is. And so it can be very beneficial to have that kind of line of credit just to assist with growth plans that a buyer may have. And so that's definitely helpful, very huge for what I know we've seen.
Yeah, absolutely. Yeah. Just to kind of finalize that piece is that I typically encourage people to go ahead and look at doing an SBA loan. Again, it's, everybody's got their projections and they're showing that, hey, we're going to make a bunch of money. Well, obviously everybody's projections just don't hit. So
normally we're selling businesses that go like that, right? And so they are expecting, which is going to happen, but there's probably just with the transition, natural, it's just going to decline for a moment.
Yeah, as a new business owner is getting their feet wet in the business and kind of ramping up revenues, understanding it, kind of ins and outs of it all. Again, it's always easier to ask for a loan before you need it. So if we did a loan and then we come back and, oh my God, 6 months, we're not going to make payroll this week. Well, not really great news for the banker and all that. Then it puts them in a little more desperate situation. So that's why we try to cross that bridge on the front end of it to say, okay, well, let's run through this scenario, see what that looks like. And
so you would advise somebody that is kind of thinking, they're about to buy this company and they're thinking, okay, what other things do I might need to look at a loan for? Okay, that might be an option. I don't think I need it, but it might be an option. So what kind of steps in the process do you really go through before they say, yes, I need that kind of loan?
Yeah, absolutely. So we'll just have those conversations with them. Again, we'll kind of run our own analysis. We've got kind of your working capital formulas, if you will. It's unfortunately it's all historical. You can try to calculate a little bit more off projected cash flow needs. But again, it's okay. Hey, if your revenues are at 5 million right now historically, but what happens if it dips, or on the other side of it, what happens? Again, we want to grow to $10 million. Okay, well, you're going to have to hire more people, and you have to go into another facility, lease that, and there's a lot of kind of upfront costs. Everybody, that's probably one of the biggest things I hear from a lot of small business owners. It's like, hey, we started up XYZ business, and I'm really good at that. Well, 80% of my time is just going and collecting receivables and trying to keep up with cash flow, and that becomes such a huge piece of it. So we try to alleviate that issue, obviously, on the front end of it. And again, it doesn't cost you anything to have it out there necessarily outside of initial closing costs. You only pay interest on the outstanding balance. So again, better have that out there. Better safe than sorry, if you will.
Brandon, one question. I know over the last few years, we've had really high interest rates, right? And hopefully those are going to start coming down here. But we've seen a lot of deals that have had seller financing as part of the financing, right? How does that affect or change the options for business owners?
Yeah, absolutely. So the SBA has actually done a big favor. Again, from a government program standpoint, the SBA has done a good job and really tried to make it advantageous for the borrowers. Again, kind of crazy to see a government entity that actually does what they say they're supposed to do. So,
wow, you're complimenting a government agency.
It's
wow, okay.
My career just went right out the
window. Cut that from the podcast.
Yeah, exactly. Well, my political career is over now, but which is probably for the best, anyways. But so obviously interest rates and all that. Hopefully, Jerome Powell kind of helps out a little bit and make it a little bit easier on the borrower. Quite honestly, even the bank side of things, it's been by design a little more challenging over the last year and a half, 2 years now, since we've been raising some interest rates and trying to lower that demand for financing. But on the other side of that is you do have some seller financing options that can be beneficial to both the seller, to the buyer, and even the bank. So certainly a lot to kind of dive in through that. But one of the changes that the SBA did come through that helps the seller. In the past, they wanted the seller financing to be fully on full standby. So it can accrue interest, but it doesn't want the buyer to pay anything back to the seller until the SBA and the bank gets paid back. So you look it out over 10 or 25 years. Well, that doesn't help me out as a seller necessarily, unless we just get desperate and need that last 20% to get the deal done. But now the SBA allows the borrower, and we basically underwrite that, to make payments to the seller under a note. So we may subordinate that note officially, but again, that allows the seller, it's like, okay, hey, I'm fine selling the business for 80% of the value today. I'll collect that, and I'll just put on a 5-year note with the buyer and allow them to come up with maybe another 10%, and that way the borrower only has to come up with the remaining 10%. So quick kind of note on that piece, we are able to use that as equity within the deal, if it is on full standby. If it's not, then it's kind of just a whole piece of the puzzle. Yeah. So again, it can accrue interest, but for it to count as equity, you're not allowed to make any payments to the seller at that time. So it gets pushed all the way backloaded till basically the loan is paid off. And that again, just to clarify, I guess that only counts it as equity for our deal. So quickly kind of hit on SBA. So the bare minimum an SBA loan requires is 10% down. Typically, obviously the more you put down, the better it is for banks, and goes into more of a strength. I'd say typically we look more in the 15% range, and then maybe even 20%, depending on the deal. Obviously, every deal's on its own, a little unique, but the 10%, the only time I typically see that is if there's real estate, the collateral's really solid. You kind of have to check basically all the boxes off of everything fits really well. If not, I'd say the 15% range is probably a good expectation for a lot of the buyers and borrowers to understand. But again, so if you're a little bit short on that, well, let's look at some seller financing and see, maybe everything's always up for negotiation. So maybe there's a way to still get there on that piece of it.
Well, that was really helpful. Anything before we wrap up, Brandon, that you would add just as far as expectations for financing options for business owners?
I'd say maybe just to kind of wrap up. I mean, it's some of the key things that we'll look for in the bank. Obviously, cash flow is king. That's a way that any traditional bank will look at deals. Is okay, what's the cash flow of the business, even on a projected base. So if it's a startup, or even if it's been losing some money, okay, well, let's get some projections, see what that looks like, and if we can justify what and kind of measure out what we think they'll achieve, then that's what we basically underwrite to is the cash flow today or what the future cash flow will look like. Obviously, we'll look at the collateral. That'll dictate a lot of the type of loan that we get you into, and then we'll look at the personal strength from a guarantor standpoint, and then their experience. I think that sometimes goes a little bit kind of under the radar a little bit as how important that is for banks. If you got John Doe coming in off the street and said, "Hey, I want to buy into a roofing business," like, well, okay, what's your background? Have you done this before? And if not, then tell me how you think you're going to be successful at this, and you really have to try to justify it. So yeah, I think that's one thing that obviously we obviously love for it to be a good fit, and same thing for y'all that you're fitting the buyer and seller to where if the business isn't successful, then the bank's not successful. So we need that to work out.
So it sounds like there are three main things that the bank initially really focuses on, right? And one is the cash, right? Cash is king, right? Cash flow. Number two is the collateral. And then number three is the buyer and really the capability of the buyer that the bank believes that this buyer is going to be successful, right? And so, yeah, that's great feedback, because it's something where I read somewhere recently where it was hey, it's not the business is worth what a buyer is willing to pay. It's more about the business is worth what a buyer is able to pay, right? And so it's about buyer capability, and it's also about the business and is it bankable, right? I mean, can a buyer go attain financing for this? And so we that's super helpful insight. I know I appreciate that for sure.
Absolutely. And I'd say all this, I mean, there's obviously plenty of banks and all that. There's two little pieces. So if you are looking through getting an SBA loan, a big piece of that is making sure the bank is a preferred lender. And really that's just a timeliness standpoint. What that does is basically once we get our internal approval, we go to the SBA and say, hey, we go to their website, put in some information, and then we basically get a loan number back. If they're not a preferred lender, they're what's called a general partner, and the bank does their underwriting, then they ship it to the SBA. They do their own underwriting, and that can just drag out the process. That's my knock on the government. They're not the most efficient, quick process.
Man, I'm gonna praise them and then knock them down in the same episode. Here we go.
Yeah, so I think that's a pretty critical piece. But then obviously just talk to your banker. Obviously, every deal's unique. Every situation's, there's plenty of experience in what you guys do and what you've seen. Same thing with the bank side of things. But certainly don't hesitate to pick up the phone and just kind of talk through, hey, I've got this situation. Let's kind of figure out a way, get creative and fit it inside the box. So that's the value we bring to it.
That's great. Well, Brandon, thanks so much for joining us today. Andrew, thanks for jumping on again. That's all the time we got for today. And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.